Okay, hi Graham. I'm delighted that you're here to talk to us. Graham Ponting of Clearwater Wealth. You also lead London Mentor Group for Truth Users. So lots of us have been wondering how you're getting on over the last few weeks and dealing with this pandemic with your clients and your planning business.
Sure. Well, I think like everybody else, it's been a fairly sort of surreal experience, really. We've been very fortunate that our investment philosophy over the years has been very much what I guess investment experts would call a buy and hold strategy, a long strategy, that we don't try and time markets. We tend to treat these kinds of this kind of investment volatility as opportunities, really, for clients who've perhaps got cash on the sidelines. And as I was saying to a client the other day, we don't know whether sitting tight and riding this out is going to turn out to be the right strategy. But what we do know is that it's always been the right strategy in the past. Not sometimes, not usually, not often. It's always been the right thing. If you can sit tight and ride through this, then you will emerge out the other side and markets will go on to test new highs. It's always really hard to truly believe that we're in the middle of one of these things. I remember the global financial crisis at the time, and when the second part of the graph hasn't been drawn yet, the recovery, it's very difficult, and you even sometimes find you doubting yourself. Maybe this time it will be different, but the reality is it probably won't. And I feel vindicated, or have felt vindicated over the years in stressing that to clients. And as a consequence, I can honestly say we've not had any panicked clients calling us about wanting to disinvest. We've had a number of conversations with people who are concerned, but if I'm honest, I think the majority are far more concerned about their family and friends and their health and what the lockdown is doing to the wider economy than they are necessarily about their immediate short-term financial plans. People that were going to move house have probably put that on the back burner. People that were going to buy a new car have just shelved that idea for now. So they don't really need huge amounts of cash in the main. You know, I've been as relaxed as I can be, and I've been very happy that clearly the messages that we've been sending to clients over the years have got through. The education piece, as I call it, has genuinely worked. And people know this isn't our fault. Clearwater didn't drop the ball. We didn't do something that we could have foreseen. And they're generally relaxed. The emails I've had are, can't do anything about it, Graham. Hope you and your family are safe, and things like that. So it's all good.
So you were telling me that you've actually got some new clients over this period. How did you manage that?
Yeah, well, that was quite interesting. I mean, we've been speaking to them, a couple of guys with quite a lot of money between them. They sold a business a few years ago and entrusted this money with a discretionary fund manager. So somebody who does think that they can play the markets and take an advantage over other investors. Not something I believe in, but that's a wider debate. But this particular firm had sold out of the market and then bought back in at the wrong time back in 2018. And myself and these clients have been speaking about how uncomfortable they were, that they were relying on one person's intuition, for want of a better way of putting it, as to when to come out and when to come into markets. And as soon as this pandemic crisis hit, the markets fell off a cliff in sort of early mid-March. This particular fund manager wrote to them and said, right, we're coming out of the markets again. But of course, as usual, after a significant portion of the pain had been felt. And it wasn't that they necessarily disagreed with what he did, they just realized how uncomfortable they were with that strategy, knowing that that's not what we do, and knowing that our service is a much wider, more comprehensive service, looking at lifelong cash flow planning, achieving their lifetime goals, etc. That was the straw really that broke the camel's back as far as the other fund manager was concerned, and they've decided to work with us. So that was great. So a bit of good news amidst the gloom was that we've picked up a couple of clients with several million between them, which we will help them with. But the overriding thing that they've joined us for is the lifelong cash flow planning, which of course we use Prestwood for.
Fantastic. So have you been doing face-to-face meetings over Zoom or Microsoft Team or any particular sort of software you're using?
Yeah, I have. I've had a couple of meetings, and perhaps not as many as some others. I'm not. I wouldn't say I'm a technophobe. I'm just a techno incompetent. I'm not really very good at working all this stuff out. So, and again, it's all very well that I've got a couple of options, but if the clients don't have compatible options, then it doesn't really make much difference. But I had a terrific meeting on Teams the other day with a client, and I was massively impressed with that. That seemed to work very well. And I had a couple of Zoom meetings as well, but not as many as I necessarily would have expected. What I have done is I've offered clients the opportunity to have that kind of meeting if they want. And I've had lots and lots of emails back from people saying, thank you very much for the offer, but I think we're okay at the moment. We'll just try and ride this out, you know, and things like that. So the offer is there for clients. If they want to have a full-blown face-to-face like we're doing now, then they're able to do that. But I've had very few takers, to be honest.
Oh, that's fantastic news. Okay, well, Graham, we'll talk to you probably in a couple of weeks' time just to see how business is going and so on. So keep in touch. Thanks very much. So, Graham, I wanted to ask you about how you are communicating with your clients during this period.
Yeah, I mean, I think this is really important, actually. It was something that I had some success with during various other small crises, nothing as big as this, of course, but little stock market corrections. What I realised is that, and it's probably pretty obvious, is that when things are going well, if you're not sending out regular communications to clients, they don't really miss them. They're not really too bothered. I mean, what I try and do is I send out probably 1 or 2 what I call round robin emails each month. And these are on something topical that's come up, just a blog of somebody else's maybe that I've read, or an article I've seen in the Sunday Times. And I just put my spin on it, top and tail it, and then send it out to people to see what they think. Now, that goes out to about 145 people. Now, I don't expect every one of those 145 to read every single one of those emails and find them interesting and relevant. But I do know that it will resonate with a number of them each time I send them out. I always get several replies. We always find your emails interesting, Graham, etc., etc. So that's fine. But what I do know is that when things are going badly wrong, when markets are reacting, we often call it, there's market volatility. I always say that's financial advisor speak for plunging, crashing or whatever. When that happens, clients are unsettled. Now, my worry for my clients was, because I'm so firm about this business of you don't sell when the markets are down, that they're almost frightened to ring me to have a chat if they are worried, because they know what I'm going to say. I'm going to say, don't do anything, sit on your hands, put your tin hat on, hide behind the sofa, that kind of stuff. So I decided to send, what I have been doing is sending a lot more communication, maybe 2 of these round robin emails a week, talking about when there's a bit of positive news or when someone's got an interesting take on what's happening, just to keep everybody in the loop, to let them know that I'm there. But I also have made sure that I've sent a couple of emails which talk more about not so much the financial side of things, but just look, if you're feeling anxious, if you're unsettled by what's going on and you want just to have a chat, give me a call. It's pretty lonely at the moment, and it's lonely for our clients, and perhaps even more lonely for those that are in this forced self-isolation. I'm talking about the people in the high-risk groups, the 70-year-olds, the 80-year-olds, which just happen to make up a fairly significant chunk of my client base. So I'm, acutely aware of the loneliness aspect, and just having a friendly chat with someone who can just reassure them that not doing anything is the right thing has proved really useful. And I've had loads of really nice emails back and phone calls from clients just saying, look, thanks for these emails. We really find them reassuring. They perhaps draw the line at uplifting, but they do like to hear from me, to know that we're here and we're listening and we're aware of what's going on. We're on top of things. And we've also made sure that they are aware that if they needed to take money out of their investments, that there are ways they can do that without causing long-term damage. Now, what I mean by that is that our portfolios are made up of a series of funds, some equity funds, some very high risk equity funds, emerging markets, smaller companies, emerging markets, value, etc. Well, they're the last things you want to be selling right now because they're off 30, 40%. But we've also got bond funds in the portfolios. And the bond funds we hold are short-dated, high-quality bond funds that are not terribly volatile. Now, they've not exactly gone shooting up during this period, but they've held their own, which means that if somebody were in desperate need of some cash, they could simply sell down their bond funds or some of their bond funds, recognizing that what's left is now much higher risk, but they're still in the equity market with their other funds for when the recovery comes.
That's the thing for clients.
Yeah, exactly. No one's done that, by the way. No one's actually taken any money out on that basis, but it's nice for them to know that in an emergency, they can do that. You know, and I think that's important. I've got a chart. Can I show you a chart?
Go ahead.
So you're ready to restart that? Yeah. So what I've got here is something. This is one of the charts I'm going to be sending out to people today, which is a series of our portfolios. And obviously, the highest risk portfolio. This is the one at the bottom here. This is the one that I'm invested in personally. So I've taken a complete hiding through this period. But you know, I'm relaxed about that. But up here, portfolio A is just our bond portfolio. Now, the way that we do things, each one of these other portfolios just contains less and less of the bonds. That's the way it works. So this portfolio down the end here, portfolio F, is 100% equity, so it has no bonds at all. So if one of my clients were invested in this portfolio and needed some money, they would have no choice but to sell out of equity funds. But of course, that's why almost none of them have got that particular portfolio. But anybody who's got portfolio C or portfolio D, and what's D? Portfolio D is portfolio 60, which is 60% high risk, 40% low risk. And that's probably our most typical portfolio, the most common portfolio. But they've got 40% of their portfolio then in portfolio A. So by selling some of those investments, they wouldn't necessarily be selling at the wrong time. And of course, once the market recovers, the intention would be to do a rebalance back to the appropriate allocation. So if a client is going to take money out of their low risk investments, we need to make sure that we've applied all the appropriate caveats, risk warnings, that it means that what's left is higher risk. But I think that's a relatively neat solution, not ideal, but it will work if somebody needed some cash in the short term. Does that make sense?
Yeah, that's excellent.
And if I show what I'm going to do with this particular blog, so if I'll get rid of that particular chart. So that's the 3 months to the close of business last night with these portfolios. But the other chart that I'm going to put on this blog today is this one, which is the last month. And so there we can see that our most high risk portfolio over the last month, portfolio A now, is actually up 13.79%. So it's just to contrast the crash that we've had. And we're nowhere near, that last chart includes what's on here the last month. But it just gives people a sense of, you know, that as things pick up, this is what we can expect to see. You know, nobody can say with any confidence whether we've seen the bottom of the market yet. Some more terrible news about second spikes of infection in other countries that have released lockdowns, really even worse than expected economic data. Could easily see these charts go back down to lower levels. But that doesn't mean a recovery won't come eventually. And I'm, you know, having been doing this for a very long time now, I've never been proved wrong in the past, that waiting it out is the right thing. And I suspect that will, you know, we will be proved right again. When this finally is unwound, albeit in a year's time, maybe even 2 years' time or longer, who knows? But that's where we are. Do you want me to show you one other chart, Sandra, that I've been sharing with people, which is one that I absolutely love? Where are we? It's this one. Now, this has come from Abraham Okasanya, and it's the UK stock market. It's got the different prime ministers through the whole period on there, but it's from 1925 up to the end of 2018. This particular one, so it probably needs to have a bit added on. But the point about this chart is that it goes bottom left to top right. There is no arguing that, you know, as long as you wait long enough, things are going to recover. Because what's important to understand is that through that period, if we go right to this end here, this is 1925. Well, in 1926 in the UK, we had the general strike. And then in 1929, we had the Wall Street crash. And throughout the 1930s, we had the rise of National Socialism in Germany. We had the Great Depression. Then we had World War II, which lasted for 6 years, 4 years if you're an American, of course, but it lasted 6 years, and then we came through that. And then we had, you know, Suez and Korea and Vietnam and every other economic shock you can think of. This is the 1973 oil crisis here, the Yom Kippur War, and so on. And markets fell incredibly sharply, but they recovered afterwards. And when we look at this global pandemic, this virus that probably will turn out to have a mortality rate of 5%, maybe much less, maybe a lot more in line with seasonal flu. I don't think that means it's the end of capitalism as we know it. I think it will just be another blip on this long-term chart. It might be a big blip. It might be one that's got a, you know, a long bottom to it. That's the bit that none of us know. But Brexit on here, the EU referendum is all on here. The 2007 to 9 stock market crash is in here. You know, these become very small things. And the other chart that I absolutely love, that I send to clients a lot, let me just see if I can find this one. I have to go to here and there, and back to here. And now I'm going to share this screen, and can I find it? Here it is. Yeah. This one, I actually sent this out on October the 19th, 2017, because it was the 30th anniversary of one of the biggest stock market crashes in living memory, which was Black Monday of 1987. And what this first chart shows is how the market crashed in that October. Incredibly sharply and so on, and it was big news. I remember I was kind of a young guy selling unit trusts then. I'd been in my late 20s, mid-late 20s, and it was the end of the world. It really was, and caused by all kinds of things. You know, lots of it, the automation in the stock market, Big Bang, all the rest of it. But then I showed that crash in the context of the whole year. This bit was when, in the first chart, it's when the market peaked, which was around about July. Then it fell away a bit, came back to October, and then it really fell off a cliff. But if we started the chart in January of that year, January 87, and we went through until the end of December, the market actually ended up. You know, so although this horrendous crash in the middle, and all those that invested at the top of the market, yes, they really suffered here. But a long-term investor actually, you know, someone had gone on holiday, let's say, for that entire year, had never looked at a newspaper, they'd have gone away here and come back here, and they'd actually been up. So what's the big deal? But much more importantly than that is how long did it take for the 87 crash to recover? And we can see here from that July date, there's the big crash, and it wasn't quite 2 years before the market had recovered back up to that high point that it had got to in 87. Now, we don't know whether that's going to happen here or not, but what's the lesson that I wanted my clients to take from these graphs is encapsulated in this last graph. Okay, bearing in mind this was 33 years ago now, but all of that we've just talked about, that 2-year period, is inside that red circle on this subsequent 30-year graph. So somebody who had lost faith in capitalism or lost faith in the equity markets in 1987 and decided they were going to keep their money in cash, for example, would have missed out on this 30 years of growth that followed. And I suspect that the next 30 years will look something similar. We may not have higher levels of inflation, and with lower inflation environments, we tend to get lower rates of return, but the real rates of return above inflation will probably still look like something like, on a balanced portfolio, 2 or 3% above inflation. Maybe they're the expectations that we need to have, but that's still going to be better than cash. So let's get all of this stuff that's happening around us all the time is by its nature short term, and we're not in this for the short term. We're in this for the very long term, the 30 years, the rest of the client's life. And so I've been dripping that onto our clients for years. And it's when stuff like this happens and we don't get the panic phone calls that it pays dividends, that really the message has got in. So that's just another chart that I like. So there we are.
Thank you, Graham. That's brilliant. It really does show that education of clients, over the long term does help and does minimise your panicked or possible panicked client.
Yeah, I think it does, and but what I also think is really important, and it was something that a lesson I learned very, very well years ago, is that don't tell clients stuff about things you don't know. When I'm talking about recoveries and so on, it's always couched with the right terminology about we don't know when it's going to happen. We don't know how far the market's going to go, and whatever happens, it won't be anything that I did. I can't control that. If I had a big button on my desk that I could press to make the stock market go up, I'll be pressing it 24 hours a day, but I don't. And the important thing is neither does anybody else. So therefore, we're all in this together. We just have to work it through. But don't give clients unrealistic expectations about what you can do, the kinds of returns that you can deliver that somebody else can't deliver, because you're going to have a real hard time proving that.
Yeah, absolutely. Okay, Graham, thank you very much for your time.
Pleasure, Simon.
Stay safe.
Absolutely. And you. Take care.
Bye.
Bye.